Hello everyone, Hemant Suteri this side, and today we are going to discuss the subprime mortgage crisis that was there in the United States in around 2007 and 8. So, talking about these three words, subprime is the category of customer that we will be discussing in later slides. Mortgage is the money that we borrow in order to buy a home or flat, and crisis here means an economic crisis. Okay, so let us move ahead. So as we all know that everything that happens has a backstory. So for this crisis, the backstory was in early 2000s there was very low interest rate provided by banks to the people on fixed deposits and other similar deposits, other similar investments. And second reason was the stock market crash. Yes, there was a stock market crash in the US in early 2000s. That was because of the e-commerce companies. As e-commerce was booming in the late 1990s, people started investing huge amount of money in the stock market. And in the early 2000s, reports came out that about many shell companies and other frauds in the share market on the name of e-commerce. So the stock market crashed. As you can see here, in the late 1990s, the stock market was on boom, and in the early 2000s, the stock market crashed at a very bad rate. So this these were the two reasons that were there behind this economic crisis. And now talking about this graph, here it shows the interest rates in percent per annum. That means if you invest 100 rupees in fixed deposits, the interest you get per annum is around a 1%. So that was really low rate. That's why people starting for looking another place to invest, another domain to invest, so that they can get good returns. So now moving ahead in this slide, now people started searching for higher return investment opportunities. Yes, as they were not getting it from the traditional places, the traditional investment opportunities that were fixed deposits and stock market, people started looking for higher return investment opportunities. So people started investing in real estate business, and government also made policies to support them. Policies were made to provide home loans at very low interest rate. Yes, banks were asked to provide home loans at very low interest rate to people, so that to maintain the liquidity in the market, in the US market. So people started taking very good interest in that real estate business. So people started taking more and more loans. So bank was running out of cash. That means running out of money, and there was shortage of bank liquidity. Here liquidity means the money that can flow from bank to one person to another person is called bank liquidity. Bank liquidity means the bank was running out of money, so that it can provide it to people for having in form of loan for investing in real estate. So banks were running out of money, and investment bankers made contract with bank. First, the thing was this short. Banks were providing loans to people. Now, investment bankers came into play. Now, this represents investment banker, this represent common people, and this represent bank. So now, the investment bankers made contract with the banks that investment banker will provide loans to bank for which they demanded interest, so that the money provided by investment bankers to the bank will be provided to people as home loans or as real estate loans. Okay, and in return to that, the investment banker will get interest on the money they will provide to bank. This was that simple. Now investment banker provide money to for loans and gets interest on the money they provided to banks. Now moving. Now the investment bankers also faced shortage of liquidity. Shortage of liquidity here means the same, the shortage of money to provide loans. Okay, so they started selling loans, CDOs as CDOs to people. Here, when this investment bankers were running out of money, they sold CDOs back to people. The CDOs stands for collateralized debt obligation. Okay, so the underlying asset of CDO was the loans provided by the investment bankers. Okay, and in return of which the people were getting interest at the rate of 3% per annum, and the 3% interest rate was quite good, as the banks were providing interest rate of 1% per annum and investment bankers are providing interest rate at 3% per annum. That was quite good. And talking about CDOs were just a document type thing in which it's mentioned that this person with its detail, that this has provided this amount of money to this investment banker, and for this much time, and till that time investment banker is going to provide interest rate at the rate of 3%, interest at the rate of 3%, and after that the investment banker will be going will return the money to that particular person. Okay, so people lack trust on CDOs. Why should anyone trust on anything that someone is selling to us? People lack trust on it. So the CRA, that stands for Central Rating Agency, gave it triple A plus rating. Okay, so Central Rating Agency, as we can know by its name, it was a government agency, and that gave it triple A plus rating, and triple A plus rating was the best rating ever given by that. Okay, ever can be given by that. It was their best rating. So the Central Rating Agency, which was a government agency, gave it the rating, its best rating. That means it's so secure. So as people now have trust on these CDOs and were getting a very high good returns on CDOs, so they started investing in it, and everyone was making profit. So now what happened was, when everyone was making profit, people here were thinking that we are getting interest rate of 3% per annum, so that was quite good. So there was the demand of the CDOs was increasing so at a very good rate. See, was the demand was so high. Okay, so moving ahead, loans to subprime customer, as these people were demanding more CDOs, and as I already mentioned, that CDOs were underlying asset of loans. Here underlying asset just simply means CDOs were provided for the loans given by investment bankers to people, investment bankers to bank and then to people. Okay, so the more number of loans distributed, the number of CDOs will increase with it. Okay, so the thing was, as people started demanding more and more CDOs, so the investment banker were there to make profit, as it was a private institution, so they were there to make profit. So they pressurized them for more CDOs, and the investment bankers provided more money to bank and pressurized the bank to sell more and more loans. So now what happened was, till now the loans were provided to only prime customers. Here the prime customers means those who have a good number of assets and were able to repay the loans, or if in case they are not able to repay the loan, they have sufficient assets to get back the money provided to them as loan. Now the subprime, this word, as I mentioned that we will come across this word in later slides. Now here's the word, and here subprime is a category of people, and this is the category of people who don't have that much as number of assets, and who are they this means that this category of people don't have a very good probability of returning the loans which was provided to them. Okay, so they were having assets, they were having income, they were having uh, they can repay the loan easily, repay the loan. There was not any surety about repaying of the loan from this category of people. Okay, these are somewhat poorer people, we can say. Okay, so now the profit on CDs was very high, CDs were in huge demand. Till now, banks used to provide loans to only prime customer, but now banks started providing loans to subprime customers. Also, because of high demand of CDOs, as demand of CDOs was so high, it pressurized the banks to provide loans to subprime customers also. The CRA, Central Rating Agency, maintained its AAA plus rating. Here's when the things started going wrong. Okay, so now when the loans are provided to subprime customers also, the CRA should have to lower the rating, but they didn't. Okay, so the trust was there, and now it's the investment from subprime customer. As you can see here, the subprime home sales thousands. From in 2001, it's from 408 to in around 2006, it's 1355. 2005, this was the result of the large demand of the huge demand of CDOs. So now moving ahead, entry of insurance companies. As everyone was making profit, so insurance company also came into the game. Now the insurance companies also started selling CDS, which stands for credit default swap, as it increases the reliability of CDOs, and they were also making profit out of it. As everyone was making profit, subprime customers, from subprime customers to prime customers, banks, investment bankers, and common people also, they all were making profit. So this represent here the insurance companies, these also came into the game. So now what they did was they sold CDOs back to people, and CDS, which stands for credit default swap. In simple words, if we just want to simplify it, that is similar to insurance. As we as we insure our, if we take health insurance or insurance of our vehicle, etc. So this was similar to that, and in return of which people have to pay premium for the CDS. As we all know, we pay monthly some amount on, if you take health insurance, or we pay some amount for our vehicles of insurance of our vehicles. So this was a similar case here. So people ignored the fact of hike in interest rate after few years, as US government had made plans to lower the interest rate for 3 to 4 years, and after that they are going to hike. There will be a hike in it. So earlier when the US government was made policies, so they made policy to support people to invest more in real estate business by lowering the interest rate for the 4 to 5 years, and after that the interest rates were going back to 5 to 6% per annum, and for the first 4 to 5 years the interest rate were around 1%. Okay, so when the interest rate hiked, people were unable to repay the loans. This was simple as the loans were provided to subprime customers also, so the people were unable to repay the loan. So moving ahead, rates hike. After hike in interest rate, a large number of subprime customers were unable to repay loan, as in around 2005 the interest rate were 1%, and in around 2008-9 the interest rates went up to 5%. Okay, so large number of people asked insurance companies and investment banker to repay the loans. As this category of people, and some from this category also, were unable to repay the loan. When they are unable to repay the loan, banks were unable to repay the money to investment bankers, and when investment bankers were not getting money, they were unable to repay to people, and people then asked for money to investment bankers and also to insurance companies. Okay, so here these two were running out. They didn't had money to provide to people. So here is what happened. Category wise due loans, and this is the due loans of subprime customers, and this much was the due loans of prime customers. As you can see here, it's around 18 to 20% of due loans, 18 to 20% due loans of prime customers were there, and around 2% of the total people from prime category were having due loans. Okay, so as we mentioned that subprime customers were not in that good position to repay the loan. That's why the due loans of subprime customers are this high. Okay, the foreclosure is just like when someone is unable to repay the loan, the banks just take over the money, take over their property. Okay, for which they took loans, or take over their assets. Okay, so this was the foreclosure started. This was the foreclosure for subprime customers, as they were not able to repay the loan, and this was the house price index, which fell down as the demand of home decreased sharply. Okay, so the aftermath. Both investment bankers and insurance companies filed bankruptcy as they were not having money and people started asking for money. So they filed bankruptcy. Thousands of people lost their jobs as usual. So those who were unable to repay the loan were no longer the owner of their house due to the foreclosure. And this is the graph for a US foreclosure with US properties with foreclosure activities in first quarter of 2007. It was this low, and in late third quarter and fourth quarter of 2009 it was this high. You can just see here, it's 2,40,000, around 2,40,000. It's around 9,37,000. It was this high. And here you can see the US unemployment rate. This dark line strip is the period of financial crisis, the subprime mortgage crisis, and here you can see the exponential rise in the unemployment rate. Okay, so moving. Bailout. So the Wall Street bailout package was approved in the first week of October 2008. The US government was not being able to bail out both investment bankers and insurance companies. They decided to bail out insurance companies. The strongest economy in the world, US, was not even able to bail out both of them. This was the impact of this crisis. Okay, so the cost of 2008 financial crisis was around 1,488 billion US dollars. That's 1.4 trillion US dollars. Okay, so the bailout package was of 700 billion US dollars, and around 831 billion US dollars were tax cuts and spendings. This was the bailout package of this insurance company. This much was the bailout package for this company, and this much was the bailout package for this investment company. So today we discussed about the subprime mortgage crisis. I hope you got everything. So this was Hemant Suteri, 14 roll number, F1 batch. Thank you.